Welcome back to the channel. My name is Steven. I'm a pharmacist. I own 52 units of real estate and I help coach people to buy their first multifamily deal. So I want to tell you what I wish I knew about building wealth from real estate. Once again, it's what I wish I knew about building wealth from real estate. So when I first went into real estate, the mindset that I had was I want to cash flow enough to replace my W-2 job. And that's why a lot of people get into real estate. That's why people buy single family homes, buy multifamily homes. That's why they do short term rentals, they do midterm rentals, rent by the room, whatever it looks like. People are trying to build wealth from real estate through cash flow. And why that's very appealing is because you can have passive income that can potentially replace your job, give you an extra stream of income, and basically help you retire early. So that was the appeal for me. I wanted cash flow so that I could use that cash flow to replace my pharmacist job so I can retire early and make work optional and make money in my sleep. And if I were to get laid off from my job or something were to happen to my job, I can still get money to survive. So that was the whole crux of why I've did real estate. And that is a nice one benefit of real estate is the cash flow. But as I've been in real estate since 2017, so this is going on year 8 now, I've built most of my wealth through appreciation of real estate. And there were two ways that I had appreciation. So I had market appreciation by buying in California, which you can chalk it up to luck and then time in the market. So I owned the property since 2017 to today. And so over time, the values went up. Over time, you have principal pay down. So your loan gets smaller, which builds you equity. So that's how you kind of build equity. You have principal pay down and you have natural market appreciation, which you can chalk up to luck and hindsight's 2020. But obviously, buying in 2017, looking back from today, it was a smart move, but it was just a luck move that I just took action, bought a deal, and it appreciated a lot during COVID when interest rates were low and people were overpaying for properties. So chalk it up to luck in my mind. But if you hold a property long enough, you'll kind of manufacture your own luck. Like from 2017 to probably 2022, appreciation was crazy. 2022 to present day, appreciation kind of slowed down a little bit, right? Property hasn't really gone down, but hasn't really gone up. It's kind of been stagnant in my opinion. So, like a lot of and then the second way I made through appreciation is forced appreciation. So I kind of did this more with my apartment complexes that I bought in Oklahoma. So keep in mind the market appreciation. I got a lot from my properties in California. I own some properties in the Bay Area, own properties in Southern California, and property values kind of appreciate more here. So it's more of an appreciation market versus a cash flow market. So like a lot of my properties are break even cash flow or slightly negative cash flow despite me self managing it. So if I had a property manager, I'd even more negative in cash flow. But they made a lot of money in terms of appreciation. So an example I like to give is my first property I bought in the Bay Area. I basically rented it out and I was negative $400 a month despite self managing it. So I was negative $400 a month. And keep in mind, since I've owned it, every 2 years I raised the rents by about $200. And on top of that, I was able to refinance my rate during COVID from 4% down to 3%. So between the gradual rent raises and refinance at a lower interest rate, I actually now make a little bit of cash flow. So let's just call it like $200 a month, which is not really much. It's just really there for like CapEx maintenance. I'm not living off that. But this property appreciated from $800,000 to about $1.4 million. So about $600,000 of natural market appreciation. Now it's not factoring in principal pay down, which I'm getting, which is maybe about $1,000 a month. Let's just call it. So $12,000 a year, times that by 8 years. So that's $100,000 in principal pay down, roughly. So as you can kind of see, that's natural market appreciation. Once again, luck. Forced appreciation are my apartment complexes in Oklahoma. So I bought an apartment complex for $500,000. I put in $300,000 of renovation, was able to raise my rents, raise my net operating income. And when you can raise your net operating income, you can force the value of the apartment to go up. So how do you raise your NOI? You can increase your expenses increase your income and decrease your expenses, and you want to do both simultaneously. So you want to increase your rents. How do you increase your rents? You have to renovate the units. When you renovate the units, you can charge closer to market rents. If you have to manage your expenses, so how do you do that? You have to make sure that your tenants are paying the electric bill. Like, you don't want to cover utility bills. You want to make sure you're shopping your insurance around. You want to make sure you can test property taxes if you can. So it's a lot of little things that you can do to manage your expenses, but some things you just can't control, right? They just get raised the price of water on you, and you're stuck to pay that. So I kind of made appreciation two ways, natural market appreciation and then forced appreciation through my apartment complexes. So that's why I do both, because you don't want to depend on luck with natural market appreciation. Obviously, if you buy in California, you're more likely to have appreciation versus if I bought like in Oklahoma, a single family home doesn't really appreciate. That's why I buy apartment complexes in Oklahoma, because it's more forced appreciation by increasing the NOI, by increasing income while decreasing expenses simultaneously. So let me kind of give a, a single family home example as to why appreciation made me more wealth versus cash flow, and I'll give you a multifamily example of why forced appreciation made me more wealth versus the cash flow. So let's talk about my first single family home I bought in the Bay Area. So once again, when I first bought it, I was negative about $500 a month. So I was negative $6,000 a year, and this is not including anything else, right? So just net, my total expense was about $4,500. I was getting about $3,900 in rents, but my expense was around $4,400. So I was losing about $500 a month. So I was negative $6,000 a year, and I could afford to take that bullet because I work a full-time job as a pharmacist, and I was okay to take that hit in my mind. In my mind, it was a forced savings because it was going to principal pay down, which is going back to me ultimately. So I didn't mind taking a $500 a month loss, but obviously that's not scalable, right? You can't scale a portfolio always being negative $500 per month. So what I did was, if you look at the appreciation, so every year that I owned this property, it appreciated $8,000. So I was negative $6,000 that month on cash flow. So I had to put $6,000 of my own money into the deal, which came back to me. But also I made $8,000 in appreciation. So that's more significant. That's 10x a return, or 11x a return, or even more. So every year that I owned this property, it went up by $80,000 in appreciation. And over time, now this property makes $200 a month. So in the beginning, I was negative. I was losing $6,000 a year, but I made $8,000 in appreciation. Today, I make $200 a month. Let's just times that by 12. I make about $2,000 a year in cash flow, but I appreciate $80,000. So the real wealth is made from appreciation, and the point of the cash flow isn't to like really live your lifestyle, retire from your job. The point of the cash flow is just to save money to have a reserve when something breaks. Like maybe the HVAC breaks and it costs me $5,000. Maybe the roof needs to be replaced. Maybe there's a plumbing issue. Maybe I need a new stove. Whatever that looks like. The point of the cash flow is just to keep the property afloat, so you're not putting your own money in the deal, so that you can have that long-term market appreciation. You can have that principal paid down over time. So the point of the cash flow is to help you stay in the real estate game as long as possible, because if you're negative cash flow and you have no appreciation, what's the point of buying real estate at that point? Rather just buy stocks, more passive. So that's just kind of one example. So like most of my net worth, most of my wealth was made by natural market appreciation and principal pay down and just holding it long term. So my first 4 single family homes in California, that's how I made most of my wealth. Most of them on average appreciated by like $500,000 each. So that's $2 million of net worth, not doing much. I just bought and held and had a tenant, and the tenant could, for the most part, cover my costs to break even, or I had to put a little money in the deal. That's kind of the summary of my single family home portfolio. Now let's go to multifamily. So this is 5+ units. And remember, 5+ units is valued based on the income. So the only market appreciation you have is if the cap rates drop. So if you have a lower cap rate, so if I have a 10 cap versus an 8 cap, and I have the same NOI, if I have $100,000 divided by 10 cap, the value is going to be less, versus if the market has natural appreciation, the cap rate will go down to 8 cap. So you take 100,000 divided by 8 cap, the valuations will be a lot higher. So that's what you see. But I invest in like the Midwest / Southeast, not as much market appreciation. Cap rates around 8. I'd call it an 8 cap to 8 to 10 cap. So for me, it's really about how do you control the NOI. So for my apartment complex, let's just talk about my 26 unit specifically. So today I gross about 18K, and after expenses, after the loan, let's just call it 6 to 8 thousand bucks a month on average. So let's just go 6,000 bucks for easy math. So I make 6,000 bucks a month, times that by 12. That's roughly what's that? 6,000 times 12. That's roughly, just call it $70,000. Yeah, I'm not that good at mental math, but it's $70,000 is what I make on this property. And and this is after I forced a lot of appreciation. So I was able to force the value from $800,000 to about 1.6 today. So I made $800,000 of forced appreciation. And on top of that, I'm making 7,000 bucks a month, or 6,000 bucks a month on average, which is $70,000 a year. So roughly, I made 10x my net worth, my wealth from appreciation, and compared to the cash flow. So as you can see, in both single family homes and multifamily, which is 5+ units, I made most of my wealth through market appreciation, single family homes, chalk it up to luck and owning it long term, and in value add real estate, multifamily. So I was able to force appreciation by increasing the NOI. So that one takes a little bit more skill, takes a little bit more operations. So even now, I my whole portfolio, let's say I cash flow 10K a month for easy math. That's 120K a year. But if you look at the appreciation of my portfolio via market appreciation and principal pay down, that's a lot more significant. Like I probably get at least 120K a year in principal pay down. So my cash flow is 120, my principal pay down is 120, and if there's any market appreciation and becomes a hot market, then that's where most of my net worth is built. So that's kind of the key message, is that in the beginning, I thought that I was focused on cash flow, but if you want true wealth, if you want to build a higher net worth, and you don't mind working still, and you don't want to be like completely retired from it, it's really appreciation is what's going to retire you. And what's nice about appreciation is once you have a lot of appreciation, I get it. It doesn't pay the bills today. It doesn't help you retire from your job today. But if you have a lot of appreciation, what you can do is you can start to sell off some of the properties, and then you can use that to pay off other properties. So I could sell one single family home, use that to pay off another single family home, or pay off my apartments, which will significantly increase my cash flow. So I've always said this, where when I'm ready to retire and step away from my job, I'm going to sell a single family home, pay off my primary residence. So now I will cash out that equity, pay taxes, pay depreciation recapture, and pay off my primary residence, wipe out my mortgage, which is about 5,000 bucks a month. I can also sell another single family home with a lot of appreciation and use that to pay off both my apartment complexes. And the loan between both of them is 5,000 bucks a month on both of them. So I could increase my cash flow by having less debt by 5,000 bucks a month on my apartment portfolio, and by not having a primary residence mortgage, I save 5,000 bucks a month. So that increased my overall position by about $10,000. So that's the power of appreciation. I can also do a 1031 exchange and trade up to apartment complexes that cash flow. So when you're in like the wealth building mode, and you want to build up your net worth and you don't mind working your W-2, you could take more risk with like high appreciation properties, as long as you're like cash flow neutral, maybe a little bit negative. It's okay, not scalable long term. But once you build appreciation, you could sell that, 1031 exchange it, buy apartments at cash flow, or trade up to more cash flow assets. So I could sell a single family home, 1031 exchange that, and go buy a bunch of new construction in Huntsville, Alabama, and own them free and clear. So, but they won't appreciate as much, but they're more of a cash flow market. So it's a fine balance. So for me, I've been all appreciation, but as I strive towards retirement, I'm going to pivot more towards cash flow and paying off debt. So that's really how you make wealth. And I never understood, like my aunt, who's a loan officer, she was always like, it's not about the cash flow. It's about, can the property self-sustain itself without you putting much money in the deal, so you can hold it long term, so you have principal pay down and you have market appreciation. That's why you want to buy in good areas. That's why, in California, it's hard to cash flow, but if you can buy in California, it's always going to appreciate. Like most of my properties in California appreciated by $500,000 each, versus the cash flow, it's very little. It's like you just need enough to like cover your expenses and break even. And so that's kind of what hit me kind of hard. So like I said, I get it. Cash flow, you kind of want that balance of like cash flow and appreciation. That's why I like owning single family homes in California, as well as multifamily in Oklahoma. So I kind of balance myself out with, California's heavy appreciation, low cash flow. Oklahoma is high cash flow, low appreciation. And together, I think it makes a good overall portfolio. And maybe Alabama could be a little bit combination of both, where you get a little bit of cash flow and a little bit of appreciation, but not as much cash flow as Oklahoma, not as much appreciation as California. So that's really what it is. So anyways, hopefully this answers why cash flow is not necessarily the answer with real estate, but it's definitely a way to keep your properties long term. So it's definitely a fine balance. Like, I'm not advocating for buying a bunch of negative cash flow properties. That's not scalable. You'll never leave your W-2 job, and if you lose your job and now you can't support that negative cash flow, you're going to lose your properties. So you want to make sure that you cash flow enough so that you can hold these properties long term to get that natural market appreciation and the principal pay down. So anyways, I know it's a little bit counterintuitive to think appreciation makes you more wealth than cash flow. And I get it that cash flow has that sexiness, that appeal, because you want to leave your job. And I totally get it. But for me, when I'm ready to leave my job, I have to cash out some of my appreciation. At that point, I can leave my job. So it just takes more moves and more planning versus like cash flow. It's different. So this is just kind of my thoughts as somebody who focused a lot on appreciation, not as much as cash flow, in my pursuit of early retirement, in my pursuit of FIRE. So anyways, if you want to learn how to buy your first cash value add multifamily apartment complex, click on my link tree down below. From there, you can see my course, my coaching, my mentorship. From there, you can send me an email if you have any questions or want a discount code. And I also have a free newsletter down below. So please check that out. Otherwise, please like, comment, subscribe. Hope to hear your thoughts and hope to see you in the next one. Thank you.